Assalamualaikum and a very good evening to Madam Ayuni. My name is FATIN Natasha binti Jari and my fellow friends are ZAIM, Amreel, AZIM and NASRUN, and we are from the A3P. So today we would like to present about MFRS 102 inventories. At the end of this discussion, we will discuss about the scope of standard and its application to inventories. For the first question, required me to calculate initial measurement using cost method. For the first question and first Roman, cost of purchase, the total cost of inventories for the 10,000 kg of cement powder purchased by Brightview on 1st March 2025. Based on transaction 1, purchase raw material, my calculation is like this. I calculate invoice price, which is 10,000 kg. I multiply with 4.50, which is the cost for the cement powder per kilogram, which is I got 45,000, and I deduct with trade discount receipt, which is 3,000, and I got 42,000. I add up with import duties, which is 6,000. I add up with freight in, transport to warehouse, which is 4,500, and I got the cost of purchase is 52,500. So in the transaction 1, which is purchase raw materials, settlement discount received paid within 10 days, which is 1,500. I do not deduct from inventory cost because it's related to payment terms, not purchase cost. So that's why. Abnormal wastage during unloading, storage cost after goods reach the warehouse, and administrative overhead. Also, I exclude from inventory cost because it's not related for me to calculate in inventory cost. So the four item is not the four additional costs I exclude from to calculate the inventory cost. So that's it. That's all from me. I pass to the next person.
Hi, my name is AZIM. Okay, now I'm going to explain the cost of conversion. First of all, fixed production overhead, RM 30,000, and for the normal capacity, 5,000 units. Absorption rate, 30,000 divided by 5,000 equals to RM 6 per unit. Actual production is 4,000 units. So fixed overhead absorbed 4,000 times RM 6 equals to 34,000. For the unabsorbed overhead, RM 30,000 minus RM 24,000 equals to RM 6,000. And now the fixed production overhead absorption rate is RM 6 per unit, which is RM 30,000 divided by 5,000 units. With actual production at 4,000 units, RM 24,000 is absorbed into inventory costs. The difference of RM 6,000 is 30,000 minus 24,000 represents as an unabsorbed overhead, which is charged as an expense in the current period in line with MFRS 102. According to MFRS 102, when production falls below normal capacity, which is 5,000 units, the resulting unabsorbed overhead must be recognized as an expense in the period and excluded from inventory valuation.
So for question number 2, the first one is we have to calculate the NRV, which is the formula is estimated selling price minus estimated selling cost, which is for example for cement powder, the cost is 41,000 minus 1,200, and we got the NRV, which is 39,800, and the same method was applied to all inventory items. After calculating the NRV, we compare the cost and NRV of each inventory item. According to MFRS 102, inventory must be measured at the lower of cost and NRV. As we can see in the answer table, for wall panels, the cost is 95,400, while the NRV is 92,500. Since the NRV is lower than the cost, a write-down of 2,900 is required. For imported adhesive compound, the write-down is 4,400, and for floor tiles, the write-down is 3,600. However, no write-down is required for cement powder because its NRV of 39,800 is higher than its cost of 38,000. Therefore, the total inventory write-down required is 10,900. So based on the total write-down of 10,900, we recorded the journal entry by debiting inventory write-down expenses and crediting inventory to reduce the inventory value to its NRV.
Next, I will explain the journal entry and advice to Miss Lina. On 31st December 2025, Brightwood records an inventory write-down of RM 10,900 by debiting inventory write-down expense and crediting inventory. This is because the NRV of the inventory is lower than it costs. According to MFRS 102, inventories should be assessed on an item by item basis where determining the lower of cost and NRV. Therefore, cement powder, wall panels, imported adhesives, compounds, and floor tiles should be evaluated separately rather than grouped together. This ensures that inventory is reported accurately and in compliance with MFRS 102.
So for question number 3, which is transaction for recognition of inventories X expense. For question number 1, explain when the cost of inventories is recognized as an expense under MFRS 102 with reference to the relevant paragraph. So based on paragraph 34 of MFRS 102, the carrying amount of inventories must be recognized as an expense, commonly classified as cost of goods sold, in the specific accounting period when the associated revenue is recognized. This ensures compliance with the matching principle in the financial statements. Furthermore, any reduction in value due to inventory write-downs to net realizable value NRV, whether caused by damage, obsolescence, or declining market rates, along with any physical stock deficits, must be treated as an expense in the exact period the write-down or loss is identified. Conversely, if a previous write-down is reversed following a recovery in market value, the corresponding amount must be recognized as a credit or reduction to the inventory expense by decreasing the cost of goods sold during the period the reversal occurs. So, for question 2, which is for the 500 wall panels sold to Databooks SDN-BSD on credit, delivered on 28 November 2025, state whether revenue and cost of goods sold should be recognized in the financial year ended 31 December 2025. Justify your answer. So, for my answer is yes. Both the revenue and the cost of goods sold (COGS) should be recognized in the financial year ended 31 December 2035. The 500 wall panels were physically delivered and legal ownership was officially transferred to Databooks SDN-BSD on 28 November 2025. Under the accrual basis of accounting, revenue is recognized when the performance obligation is fulfilled and control of the goods passes to the buyer irrespective of the cash collection date in February 2006. Furthermore, MFRS 102 paragraph 34 states that when the inventories are disposed of, their carrying amount must be expensed as COGS in the identical period that related revenue is acknowledged. This application perfectly satisfies the matching principle. Therefore, revenue to recognize is 110,000 ringgit. For cost of goods sold, COGS to recognize is 78,000 ringgit. So, for gross profit is 32,000 ringgit, which is 110,000 ringgit minus 78,000 ringgit. Question number 3, which is for the 200 panels held on consignment for Mega Retail SDN-BSD. Advise Brightwood on the correct accounting treatment at 31 December 2025. Should these panels be included in Brightwood's closing inventory? So, in this current situation, Mega Retail SDN-BSD merely acts as an external agent tasked to market and sell the wall panels on behalf of the principal company, Brightwood SDN-BSD, even though the 200 wall panels are already physically held and stored at Mega Retail's premises. The actual legal ownership of these goods still remains fully with Brightwood. Consequently, this implies that the control along with all the significant risks and rewards of ownership have not been successfully transferred over to Mega Retail. Furthermore, under the specific consignment arrangement, Mega Retail is only required to make payments to Brightwood after the panels are fully sold off to the actually end customers. Therefore, the physical transfer of goods to the agent's location under this agreement does not qualify as a completed sale. At this stage, Brightwood cannot recognize any form of revenue or cost of sale in its financial statements because the inventory is still within its own effective control. Under the regulations of MFRS 102, inventory must be continued to be recognized as current assets on the balance sheet as long as the entity retains full control over them. Since the 200 wall panels have not yet been sold to any end customer by the financial year end, they must remain as a part and component of Brightwood's closing inventory. Therefore, the 200 panel wall should definitely buy include in Bright Bull's closing inventory as at 31 December 2025. They should remain classified as inventory until they are officially sold to the final customers, at which specific point the relate, venue and cost of sales can be related by separately recognized.